Good afternoon, ladies and gentlemen, and welcome to our brand new monthly installment of Market Moves and Insights, where we unpack the latest headlines and market swings to help you see the forest from the trees. We got a lot to cover in this first section, including some pretty bold topics. So before we get into any of that, let's quickly tick off the legal and compliance side of things. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. With that out of the way, Dimitra, what are we diving into today?
Yeah, thanks, Paulina, and welcome everyone once again. So today we will go through several major developments that are shaping global portfolios during past months. We'll start with the ongoing decline of the US dollar, but not just in isolation, but we will go through everything what's going on behind it, a slowdown in US economic activity, persistent inflation, especially in services, divergent interest rate policies across developed markets, and upcoming changes in US tax policy that could have far-reaching investment implications. From there, we'll explore what all of this means for investors, especially when it comes to currency exposure, regional allocation, and market leadership. And finally, we'll walk through the key shifts we have made in our portfolios to stay aligned with this new environment. So let's begin with the first, and I would say arguably most telling signal, the US dollar. Cam, what are we seeing there?
So first of all, thank you very much for that introduction there, Paulina, and thank you, Dimitro, for that great segue there. As you mentioned, we've got a lot of topics here to unpack, and really the elephant in the room there, as you mentioned, is the US dollar. And it's been an absolute roller coaster of a ride. But unfortunately, this roller coaster for the last 6 months has only been in one direction. I mean, if we look at sort of the dollar index as a basket, so that's the DXY index, which is what many would refer to, it's down about 11% for the year. You know, on the back of that, we've also seen exceptional strength in the euro and the pound, up 13% and 10% respectively. And if we look at those things in isolation, those are huge moves, especially in you know a very rapid time frame there of just 6 months, right? Now, if we take a step back of what are some of the things that actually drive currencies, right? So what are some of the things that drive a weaker dollar, stronger dollar, and why should you be caring about these aspects there as an end investor? Well, there's really three things that drive currencies. It's interest rate differentials, GDP growth rates, and the last one and most important, which we'll touch upon a little bit later, is that perceived stability of the country for that currency. Now, if we take the first couple of aspects there on the interest rate differentials, now essentially in layman terms, what that means is how much am I getting paid in one currency versus another, and if I can borrow in a cheaper currency like the Japanese yen, etc., and then park it in the US and get a higher interest rate on my borrowed amount there. Again, assuming the exchange rate stays the same, you basically net the difference there. Now, what ends up happening is when those interest rate differentials are in your favor, basically, or in the currency's favor, you typically end to have a stronger currency. So in this instance, we would expect a stronger dollar, but we've seen the exact opposite, right? So the question there is why. So if we look at Europe in isolation, I mean, the European Central Bank, the ECB, their central bank interest rate is sort of at 2% right now. And since last year, they've cut rates by 8 times in total. And if we look at the US, the current Fed funds rate is still at 4.25%, and they've only done 3 rate cuts. So we had that first big jumbo rate cut last year of 50 basis points, so half a percentage point, followed by 2 more subsequent 0.25% rate cuts there in the US. So with that in perspective, you would expect the euro to be weaker and the dollar to be stronger just because, well, the dollar is paying you more in the way of yield there. But what we've seen is the exact opposite. And that goes to the third bullet point that I was mentioning of those 3 aspects that drive currencies, which is that perceived stability. And I think we've seen anything but stability in the last 6 months from the current US administration, whether it's on the tariff aspect there, announcing all of those absurdly high tariff rates, both on adversaries and close allies as well, really threw a wrench into the global macro framework there of how foreign investors particularly perceive the stability and the safety of the US in that regard. So all of those things in consideration have led to that severe weakening in the dollar. And one of the things before we segue to the next aspect there, Dimitri, is this current administration, when they first came in, one of the agendas that they had at front and center was getting that weaker dollar. And they've gotten a weaker dollar, but I think they've achieved that for all the wrong reasons. Now the question, that we'll have to unpack later on is it, any means necessary to get to the objective, or are there sort of unintended consequences down the line that, we just aren't seeing just yet? And again, we'll have to wait and see.
Right. So all of that does sound pretty alarming. With the dollar sliding and policy all over the place, it feels like we are heading toward a cliff. But is this really a crisis in the making, or is there actually a way to navigate it? What does this kind of environment mean for investors? And are we just managing risk here, or are there any opportunities beneath the surface? Cam, what would you say about that?
So that's an excellent question there, Dimitri. On, we've established that the dollar's declined by 11% in the last 6 months. So the question is, what are the opportunities out there, or is this sort of has the ship already sailed, and what can we be looking to do? From that perspective, if we really look at it, it really impacts those international investors. So particularly for our clients, a large part of them are expats who live abroad, mainly throughout Europe and the UK and some other regions, right? So if you're living outside, so let's just take the example of Europe, chances are that your cash flow needs and liabilities and income expenses are probably going to be in euros, right? So again, when these currency differentials play out in your favor, which we've had over the last 10 to 15 years with the stronger dollar, right? It's been beneficial to have a higher weighting to the US in that regard, because, well, the dollar was really the only game in town. Naturally, the calculus has shifted quite significantly in the last 6 months to where that 11% decline in the dollar basically means the euro has gone up in just the same amount. So any US based assets that you had, particularly on the fixed income side, let's just take a really nice simple example like a US Treasury bill. Right now, Treasury bills are giving us about 4% on the US side, right? So if you're an international investor, you'd collect your 4%, but that 4% is in dollar terms. Now, if the dollar goes down by 11% compared to the euro, well, guess what? Instead of collecting that 4%, you've basically lost, close to 7% in euro terms, right? And that's one of the real considerations here that we need to be mindful of and aware of, especially for our international clients, is making sure that we stick to that internationally diversified portfolio, but especially on the fixed income side, those are where some of the real opportunities are going to be in having your fixed income in UK gilts or European individual bonds there to manage and mitigate some of that currency risk. So those are some of the opportunities there. But with that said, I think that the question that some clients or investors will have is, well, is this now time to sell the entire US market, i.e. should I be getting out of my S&P 500 exposure? Now that's a little bit interesting in that regard, because if we take a step back, the S&P 500, despite being a US index, a lot of those large names that make up the index are really international companies if we think about it, right? So here's a really interesting statistic that we've probably gone on ad verbatim in our past newsletters and past webcasts as well. 60% of the tech sector of the S&P 500 gets its revenues from outside the US. So this is in euros, pounds, Japanese yen, etc., and all the other various different currencies. So all of a sudden, when it comes time to earnings season, even if you do get that weaker dollar, guess what? Those earnings will look great in dollar terms just because, the dollar's depreciated in that regard. So from that perspective, we don't want to entirely eliminate and, completely outcast the US markets entirely. But again, it's getting that balancing edge of getting the right exposure on the equity side, but more importantly, as I was mentioning earlier, really dialing down on that fixed income exposure and making sure we have that in the currency we'll actually be spending it in.
Well, perfect. That makes a lot of sense. And clearly, the currency picture is shifting fast. But I should say that that's only one part of the story. We still have inflation, which is very high, especially in services. And this keeping the Fed on pause, while the other central banks, as you said already, have started to ease. Yeah, I already touched this a little bit, but how do you see the rate landscape developing from here, and what the impact is going to be on the portfolios?
Yeah, so that's an excellent part there, which is, inflation was really the driving story last year. And to some extent, it could still creep back up in the latter half of this year, which is why, we're still making some of those tactical adjustments in the portfolio, but we'll cross that bridge later on in this webcast here as we take a deeper dive. But really, inflation has made great progress, both in the US, here in the UK, and in Europe in getting down to that 2% target that many central banks would like to keep it anchored at, right? But if we take all of that in isolation, there's still a lot of uncertainties on the horizon that could really dislodge some of that longer term trajectory there. Now, if we look at sort of interest rates first, we'll tackle interest rates and then we'll go on to how that ties into inflation. Now, if we actually, maybe it's a good time to throw up one of these slides here that we've got on the deck. So let me see if this actually works. There we go, perfect. But basically, just to unpack this for our audience here, what we're looking at is just the market expectation for where central bank interest rates will be for the four major economies out there. So the US in gray, you've got the Eurozone, UK, and Japan. Now, if there's one thing that's clear in this, it's that all three are expected to have lower rates in about a year's time than where they are right now. Japan being the outlier in that regard. Now, it's interesting for a couple of reasons, because if analysts are expecting that we might get 2 rate cuts towards the end of this year on the US side. Now, Europe has pretty much already done a lot of its cutting when it comes to interest rates there, because they were able to get inflation under control much more quickly on their side of the pond there. So the question remains is, if we get those 2 rate cuts there in the US, again, that's just going to be another negative for the dollar, because again, going back to our first point there that we touched upon, Dimitro, one of the key aspects that drive currencies are interest rate differentials, the other two being stability and GDP growth rates. So if we take that into consideration, there could be further weakening in that dollar over the course of time. Again, nothing ever goes down in a straight line in 6 months, but then again, here we are. So all of that in consideration, how does that tie into inflation, right? So the reason the Federal Reserve in the US has really been a little bit cautious in that wait and see approach, and the reason we haven't got any rate cut, well, any substantial rate cuts on the US side, much to the dismay of Donald Trump, despite his insistent nudges to Jerome Powell, is that on the services side, it still is very, very sticky, right? And what I mean by that is US inflation is very much led by the services side, whereas in Europe, if we look at it in a historical context, inflation really gets unanchored on the energy side, because, well, Europe as a whole is much more reliant on exports versus the US, being a large producer of a lot of those energy goods ever since the fracking revolution. But when we take all that into consideration, the biggest obstacle that the US faces is the tariffs. Now, regardless of which side of the political spectrum that you sit on, a lot of economists that you talk to out there do agree that high levels of tariffs, A, cause a lot of barriers to global trade, and B, they do have a very high probability in increasing prices of those finished goods that consumers buy. And just by doing so, by the very definition, that should lead to higher inflation. Now, the last two prints that we've seen out of the US, that hasn't exactly materialized, but the question is, was that just because a lot of these large companies like Home Depot, Walmart, etc., were just stocking up on inventory well in advance, or do we still have more of that to play out? Again, like the Federal Reserve, we'll have to continue to remain data dependent on that and see how some of that plays out. But that's why, again, we'll touch upon this a little later, but that's one of the reasons we also have, a diversified basket of commodities in the portfolio, is to really give that barbell to our clients' portfolios in the event that inflation does, creep back up as it did in the 70s and 80s. Again, we're not predicting this. We hope we're wrong in this, because it means a substantial part of the other assets in the portfolio will do quite well. But again, it's hedging out some of that uncertainty that we do see on the horizon there. And, again, interest rates will tie into some of that, because if we do get, aggressive rate cuts in the US, again, that does have the possibility to stoke up inflation as well on that, consumer side.
All right, so basically from everything what you're saying, we can just sum up that on the one hand, we've got the Fed on hold and inflation is still sticky. But on the other hand, rate cuts starting to come through Europe and elsewhere. And this creates a completely uneven landscape, I should say. So for the fixed income investors, as you said a little bit earlier, it's not about just chasing a yield anymore. It's about navigating the duration risk, currency exposure, regional policy shifts, and everything all in once. So how do you think about the positioning when all those forces are pulling in different directions?
So that's always the conundrum, right? It's how do you balance those different risks out while achieving the investment mandate that you have for a given risk level or for a given client situation. And in this instance, I think the currency aspect is really item number one, right? It's the highest priority, especially on that fixed income side that you were mentioning, Dimitro, because in the past, even if you were living in Europe or the UK, you could afford to have some of your bond exposure in the US just because it was paying you more in the way of yield there. And you didn't have to worry so much about what the dollar would do, because for the last call it 17 or 18 years, it's done nothing but go up in one direction, right? Again, going back to the whole US exceptionalism trade. Now, naturally, the last 6 months has caused some of that to come under question. But really, it wasn't a bad bet to have all your eggs in one basket, that basket being the US. Now, as things change, and they are changing very, very quickly, what we're looking at for those real opportunities for clients is making sure, if you're here in the UK or Europe, making sure some of that fixed income exposure is more Euro-centric or is more pound-centric, because there's real opportunity there in the way to diversify out some of that currency risk. Yes, we'll be getting slightly less in the way of yield in Europe. Again, if we're comparing apples to apples, right? If we look at European government bonds like, German bonds, so that's the equivalent of US treasuries, they're giving us about 2% versus the 4% in the US, right? But again, the question is, are you going to lose more than 2% on the currency side? Compared to what you'll make on the yield side, right? And that's the calculus there that we're really trying to balance out. But beyond that, there's still corporate bonds as well, and particularly on the high yield side as well, which is where we've been selectively adding a little bit exposure on the international side, to where we're not completely giving up some of that income generation ability by just going from 4% in the way of a yield down to 2%, but also looking at hedging some of that currency risk there. To sum that up, really what I would say is, you should really be speaking with your advisors here at Dunhill Financial to discuss some of those future income needs and cash flow needs that you might have in GBPs and euro or other currencies, so we can help manage that cash flow risk and that currency risk for you.
All right, Cam. All right. So we already have talked about the rates, we talked about the inflation, but right now there is another lever that's been pulled lately, the so-called big, beautiful tax bill. And that sounds so promising, but is it really that big and that beautiful? Uh, in regards of this, I keep hearing about the Section 899 especially. So is it in or is it out? With all these talkings about that, it feels like some kind of legislative tennis match, and especially that's yes, that's pretty actual since we are here down in Wimbledon. So yeah, what's the real story there, and why, first of all, why should our clients care about this?
So that's a great segue for the tennis fans out there, which is that Wimbledon is definitely in full fever pitch there, down on that side of London. But really, this whole political theatrics that we've seen surrounding this big, beautiful tax bill has really been a tennis match, right? If you think about it, so much back and forth, both on the left and the right, and even in between the parties, right? Of negotiating on some of the aspects, like whether it's the SALT deductions or various other pieces, and this particular piece was really pivotal in the way that it grabbed a lot of international investors' attention there, and that's the Section 899 that you mentioned, Dimitro. Now, just to unpack it for our audience of what this particular clause in the big beautiful tax bill, which, by the way, that is the official name, so it'll go down in the record books as the big beautiful tax bill, regardless of whether you think it's beautiful or big. But basically what this Section 899 clause stipulated was that the US would have the ability to arbitrarily apply what's being dubbed by many economists and people on Wall Street as a revenge tax to international investors and really anybody that had US assets, so whether that's US stocks, US bonds, or US ETFs, but they lived in a particular jurisdiction or country which the US deemed as having unfavorable treatment to the US, whether it's on trade or any other policies, etc. Basically, it was a carte blanche to say if the US didn't really like what you were getting up to, they could really punish you via the capital markets very significantly. Now, there's a reason the US markets, the US capital markets are the largest markets out there, and even the closest contender, being Europe, still has a long ways to go to fill that gap. And the reason that the US capital markets have become so large and thrived is because of the freedom of movement of capital, right? And by having this clause in this, really it set off alarm bells in a lot of international investors. So not just our client base and ourselves, etc., but really large sovereign wealth funds and pension funds that are outside the US. All of a sudden they were questioning, hang on a minute, if I'm going to be taxed at a punitive rate in the future, all of a sudden do my growth rate assumptions come into question, right? If the US can then go ahead and apply these punitive taxes on me. And then all of a sudden we started to see a lot of rumors and also some concrete action of people really being panicked about it and considering the possibility of pulling money out of the states or just repatriating capital back to their home countries. We saw that play out the last couple of months in spades in the way of Asia, right? A lot of Japanese pension funds and in Korea and Taiwan, because of this, plus currency fluctuations, I should add, were repatriating capital at significant rates. But again, the silver lining there is that a couple of people in the administration came to the senses and realized that this probably wasn't a good idea to keep in this big beautiful tax bill. So since then it has been repealed, so we don't have to worry about it to that extent. But again, there's a myriad of other things that are still in that tax bill that could have impacts for international clients and particularly American expats. And to that, I'll defer to Brian's newsletter that was sent out yesterday, which goes into it in a little bit more detail. But again, the bill has just passed the Senate, and it's still and now it's with the House. But again, there's still going to be a couple of hurdles there to clear before we finally get a revised copy. So as always, the proof will be in sort of the text that gets finalized there. So we'll have to wait and see how some of that impacts clients. But again, if any of our audience members or clients have questions on that, please do reach out to your respective advisor.
Okay, thank you, Cam, for unpacking this particularly interesting topic. So right now, with this scene, we went already through the whole major macro pieces, from the dollar to rates, inflation, and right now we finished with taxes. So I believe that's the perfect time to touch on how we change and adjust our portfolios. You already started talking about this a little bit earlier, but I believe right now we have to unpack this completely. So from the top of my mind, earlier this quarter, we fully exited the covered call strategy. That was the income strategy that helped us when the market crashed, but then it started to captain the upside potential. We reallocated these proceeds to international equity exposure, right? Then I remember we increased our commodities as the hedge, and we've been steadily shifting from long duration treasuries to some higher yielding bonds and international fixed income. So can you please walk us through a little bit more in details in terms of the fixed income side and how do we deal with all what we just discussed?
Yeah, absolutely. So, as I was mentioning earlier on in this webcast there, really what we've started to do, especially early on this year, is start to pivot some of that US heavy equity exposure and particularly on the fixed income side, I should add, actually, we've started to pivot that more onto the international side, right, to diversify out some of that currency risk for our clients, but also picking up some opportunities there in the way of, better yields, especially on that high end, high yield side there, and really trying to ballast the portfolios for our international investors there. But aside from some of the changes we've done on the fixed income side, I think what we've also done is some of our thematics, which I know you'll get into a little bit more detail here, Dimitro. They've been really good bellwethers, I should say, in the portfolio to hedge against some of that volatility that we saw very early on in April because of the Liberation Day, as it was being dubbed, but I think officially it should actually be called Obliteration Day for all the chaos that it caused. But some of those satellite positions have proved quite beneficial in the way of providing that ballast to the portfolio. But again, to get back to your point on the fixed income side, really the key aspect there is making sure we're paying attention to the currencies, because again, that's something longer term that could derail clients' longer term retirement plans. So we're really fixated on that like a hawk. And also on the equity front, I should add as well, just selectively taking some of our profits on the US side, where valuations have by whatever metrics you look at have gotten quite expensive, and again shifting that into some of the international elements, particularly in Europe and a little bit in Asia Pacific, where there's now real, a growth catalyst there in Europe at least, but more importantly, we've got the currencies going in our favor instead of against us.
All right, Cam, thank you. Thank you for taking this. And everything for the rebalancing side, what we have stepped away and where we have leaned in more recently, that's pretty understandable in terms of all the strategy. But I just wanted to pick up one thing that you mentioned. The satellite positions, especially the thematics one. And the one sound, not that usually not the one is coming from the top of the mind, right? The infrastructure one. So why do we remain committed to this particular theme?
That's an excellent question there, Dimitro. And I think to really cap it off, it's sort of infrastructure as a theme, right, has really been something that's left to the wayside, at least, if we look at it from a 5 to 10 year horizon. And really in the last sort of 3 to 5 years, it's gained a little bit more momentum and traction there. But really, just to give a bit more context here to our audience, one of the satellite positions that we have in the portfolios is grid. And that really plays on the US plus international infrastructure theme is what it's really trying to play there. And what we're trying to do here with some of these satellite positions, and particularly in the way of grid, is how do we get exposure to some of these exciting narratives and growth stories like AI, etc., but without necessarily having to buy NVIDIA, right? Again, NVIDIA is really the poster child of this whole AI-driven growth story there, and it shows in the numbers, right? If you look at their revenues or any of the metrics or profit margins, year over year in the last 2 to 3 years, it's exploded, and so has its market cap, right? It's gone from being less than $1 trillion all the way to $4 trillion in a very short span of time. So then the question was, okay, well, we've got this really interesting growth story out there. But again, some of these companies that are directly tied to that growth story, they're trading at a little bit expensive valuations, right? I.e., everything has to go exactly perfectly in line for them to really grow into those earnings multiples, which it can very well happen. But the slightest wobble could derail some of those longer term trajectories. So the question is, how do we get exposure to that theme, but at a cheaper valuation? And that's where some of this infrastructure thematic play really comes into perspective here. Because if we look at it, this whole AI growth story, at the end of the day, you still need the physical hardware and infrastructure behind it to power those massive data centers, right? And just to give you a little bit of numbers and context, as of January last year, some of those big hyperscalers that we would typically consider as being at the forefront of this AI story, like Amazon, Microsoft, Google, Meta, OpenAI, etc. It was projected that that they'd be on pace to spend about 234 billion last year in the 2025 calendar year on those data center upgrades, etc., and building out those AI capabilities. And as of last month, that already stands at 320 billion. So we've blown past some of those estimates of how much these large conglomerates will be spending on those data center rollouts. And again, it's just another way to get participation in that growth story, but at much cheaper valuations, right? Because if you think about it, somebody still has to build the physical warehouses, so you have the construction element in there. You've also got the physical servers and networking, switches and cables, and the cooling and all of the logistics that go behind keeping these vast data centers operational. Not to mention the power generation capabilities of all that really suck up a lot of power to drive some of those server racks there, right? And so all of that in context, this just gives another avenue to have participation in that story, but again at a much more defensive valuation there. And here's your last statistic, on this theme here, just before we close off, because I know we're slightly over time here. But basically, by the end of last year, there were sort of 5,700 public data centers, about 5,100 co-location sites, and about 532 hyperscale sites. So those 523 are the ones owned by the likes of Google, Amazon, Meta, etc. And basically, the latest estimate by one of the research analysts there is that by 2030, so in the next 5 years, global public data centers are projected to grow about 47%, reaching about 8,400. So in the next 5 years, if we're doubling the data center capacity, not all of it will be on AI, mind you. Some of it will be your traditional data centers to power the increased digitization and increased devices that are all interconnected. But if we're doubling that capacity, somebody has to build that somewhere, right? And again, those companies in that infrastructure ETF there that I was mentioning are well positioned to take advantage of that. So again, it's just having different tools in the tool shed and how we can get some of that exposure. But again, at valuations that are a little bit more attractive.
Thank you both so much, Cam and Dimitra. That has been very interesting. And thank you to the audience for tuning in. And if you have any feedback as we continue this series or any questions, you can drop us an email at paulina@dunhillfinancial.com. And until next time, thank you.
Perfect. Thank you so much, Paulina, for hosting this, and thank you, Dimitro, for those interesting questions along the way. And again, to our audience as well, thank you very much for tuning in. And we hope to see you all on the next month's podcast. Thanks so much.
Thank you.
Thank you.
Bye.